There's a lot that gets said about the things that you should do when investing, but not a lot gets said about the things that you shouldn't do, especially when you're just starting out investing. So that's exactly what we're going to cover in today's video. We're going to go through some of the key things that you need to watch out for and the things that you need to avoid to help your investment portfolio grow as much as possible. If you're nervous about starting investing, you've just started recently, or you've been investing for a while, all of the things we're going to cover in this video are going to be relevant for you regardless of what part of the journey that you're on. By the end of this video, you'll know some of the key things to look out for and the key pitfalls to ignore in order to help your investment portfolio grow as much as possible, with the ultimate aim of having as much money as possible when you reach your financial goal. So let's dive straight into some of the things to look out for. The first thing to not do is worry about when to get started. As the old adage goes, the best time to start was yesterday, but the second best time to start is today, and that is applicable to investing as it is to any other situation it's applicable to in life. The best time to get started with investing is today. You can spend endless amounts of time doing research, reading articles, and eventually you'll always find ways to convince yourself of not starting something. Some of the key reasons why people don't get started in investing is because they don't understand, or they think that the stock market is a scam, or they think it's too complicated. And quite often a lot of those feelings can come from actually doing too much research rather than not enough research, because you end up down all sorts of rabbit holes that can confuse you. But the tip here is to stop worrying about those things and just get started. You don't need to start with a massive amount of money. We're not saying here that you need to take £10,000 and stick it in the stock market tomorrow. You could open up a stocks and shares ISA off the back of this video with £100 with many companies out there. I'll link a few down in the description so you can just check out the ISA products that they offer. But you can ultimately start investing count today with £100, with even less, with £50 even. You can just get something open up and started so you can start to get a feel and understanding of what works from you from an investment perspective. Rather than sitting back and worrying about all of the what ifs, ultimately no one can predict the future and no one knows what's going to happen. So rather than delaying and potentially missing opportunity and missing that time to build wealth for your future, instead just get stuck in and open up an account with a really small amount of money in it so that you can get a feel for what investing is like. Delaying today could cost you thousands of pounds in the future when it comes down to retiring. You're also unlikely to be able to time the market. People quite often sit there and think, oh, I'll wait till the market is in a really strong point and then I'll invest. And ultimately, as we'll come on to in a few other points later in this video, that can arguably be the worst time to get involved, is at the time when you feel most confident to get involved. So instead, sit back today, have a think about what you would actually need to do and what would it entail for you to dip your toe in the water and just get started with investing, opening a simple account. I should probably jump in here nice and early in this video to say that nothing you hear in this video today is financial advice. It's all me just giving my opinions on the market, where things are at the moment, and what I personally would do in my situation. So your situation might be completely different. So as I say, nothing in this video is financial advice. But let's move on to the second thing to watch out for. The second thing to not do when investing is, if your mate tells you about a stock, don't touch it. I'm being a little bit crass there, of course I am, but the principle here is, the likelihood is if someone's telling you about a stock down the pub or anything like that, the likelihood is that stock has already made the news, the growth has already been achieved in that stock, and jumping in at that point is probably not the right time to do it. I should caveat here and say, if you're best mates with Warren Buffett or another really famous investor from kind of over the last 20 or 30 years, sure, maybe if they give you some advice down the pub, maybe you should listen to it. But I'm willing to bet that 99% of people watching this video are not friends with those people. If you are, please do drop a thing down in the comments, because I would love to hear if anybody watching this video happens to have connections there. But I'm willing to bet that most of you don't. So that's why this point rings true about not listening to a mate that tells you about a stock down at the pub. And that is where most investing advice comes from. You'll be amazed how many investing journeys start by someone telling them about something down the pub or out for dinner or out at a business meeting or something like that, rather than coming from research at home, putting the time in to work out which stock might be the right stock for you. Now, for me personally, investing in individual stocks isn't even really a strategy that I adopt. It's not personally the route that I want to take. And if you're somebody that wants to have a more passive approach to investing, I'd argue that individual stocks isn't the route for you either. So this point is especially true if you're not comfortable putting the amount of time and effort in needed to pick out individual stocks and you want a more passive approach to investing. In that case, definitely don't listen to any advice you receive down the pub about individual stocks. It's even more relevant. As human beings, we are programmed though to listen to the people closest to us. Those people that provide us with life advice or friendship advice or any of those types of things, if they were to provide you with some investing advice, they're probably the people you're most likely to listen to rather than a seasoned professional who actually knows what they're doing, because that might seem like something that's out of reach to you. But think of it this way and analyze it in this way: is that person qualified? Has that person consistently shown return on their money and the stocks that they've picked in the past to validate their future opinions? Would you trust that person with giving them your life's worth in order to turn that money into more amount of money in the future? There's lots of questions like that you could ask yourself, and if the answer to any of them is no, then listening to that advice down the pub, out for dinner, in a business meeting is not the right place to take your investing advice from. Instead, either put the time in yourself if individual stocks is the route that you want to go down, and research and understand the stocks that you personally want to invest in and the ones that are right for your strategy, or look to work with a qualified professional, someone that knows the market, is experienced in the market and has shown good returns over time. You're far more likely to get better value out of your money by going down those two routes than you are listening to a friend down the pub. The third thing not to do when trying to grow your investments is paying too much attention to the news. This one's really relevant for the time of filming at the moment. There's so much going on in the world at the moment and a real shift in the political mindset of a lot of different countries out there, which can make investing feel like a really dangerous choice to make and a really dangerous thing to maybe add into your life. And then when you compound that with all of the things that you see in the news, and you see stock market crashes here and this is going to affect the price of oil, etc., all those news stories we've all seen over the last few weeks or so, it can really create a fear culture around investing, and what the actual purpose of investing is can get a bit lost in that. The news can be a really significant trigger of stock market activity. Again, if you just take examples of some of the things that are happening in the world at the moment, there's been so many articles I've personally seen published about how the stock market's going to burst, the stock market's in decline. And yes, the stock market has seen, and when I say stock market, I should say that I'm talking just globally here across the board. It's not anything specific or any specific country's fund. It's just global stock market across the board. We have seen a dip recently in the value of stocks and shares, and that's understandable with some of those things that I've mentioned going on in the world at the moment. But because some of those things are going on, it doesn't mean it's completely doom and gloom. The stock market is a terrible investment. It's never going to recover. And that's, I think the recovery point is a really important one. There are so many times where you can go back through the course of history. As I'm talking, I'll pop a few up on the screen here that just pop up and circle in on crashes that have happened in the stock market over the last few decades in particular. But inevitably, the stock market has always so far recovered to be at a higher value than it was before those crashes. And that's again relevant here, is that you might be seeing lots of things in the news that if you were to just take those in isolation, would be saying don't invest in the stock market. However, they fail to point out that over the course of history, the stock market has always gone on to get those returns back and go on further in the future. There's a large school of thought that says actually when stock markets dip, like we're seeing a little bit at the moment, that's actually the time to get in, because it's like stocks and shares being on sale. So you could argue in some ways that you could listen to the news, but listening to it in a way that prompts you to start investing and not in a way that stops you from investing. The best piece of mindset work I did for myself in this situation is programming my brain to think about the long term. Investing is not a short-term game. If you're coming into investing looking to make a quick win and not in it for the longer term, you're going to have to adopt different strategies, and it's always going to be really difficult. I'm going to use a football analogy here, so apologies for anyone watching that's not a football fan, but I think it's a really good way of kind of describing the position of stock market dips versus the longer term approach. And that's, imagine your team conceding a goal in the 20th minute of a game and you go 1-0 down. At that point there, you're unlikely to make a decision to get up and leave the game because you think, oh, this game is over. Instead, you're likely to sit there and watch the remaining 90 minutes in the hope that your team recovers that deficit and goes on to outscore the opposition. That's really exactly the same as what we're talking about in the investment market here. It's all about what happens across the entire 90-minute game, not what happens in a single isolated moment in the game in the 20th minute. Sure, you could have a multitude of things that happen. So say there's a goal in the 20th minute, a goal in the 40th minute, 2 more goals in the 50 minutes, and by the 60th minute your team is 4-0 down. And then you might decide that, you know what, enough's enough, I'm going to head home. And that could be applicable to the stock market as well. If you were to see 4 significant declines at individual points in time without any gain back, aka your team scoring a goal, sure, you might decide that investing isn't for you. And that would probably be a perfectly fair and valid opinion to take at that time. But if your team just concedes that 1 goal, you just see that 1 dip in the market, it's unlikely that you're just going to walk away at that point. And investing is exactly the same. The investing here is long-term and to reach those long-term goals across that full 90-minute game. So keep your money invested and watch what happens in the future and see what happens with the stock market after some of the news points that make it maybe seem more negative than it is at the moment. Now, these last couple of points I'm going to cover, I actually need to give a shout out to another content creator in the finance sphere, Toby Newbat, because I've taken a couple of these points from a video that he created. I'll link that video down in the description, but I just think these points are just really important for any kind of vision that you're looking at towards things not to do when investing. I think they're really important. So as I say, I'll link that video down in the description and shout out to Toby for these great points. So the next thing to definitely avoid is chasing winners. Chasing winners is a classic pitfall that so many people fall into when investing in the stock market, particularly people that have just got started. And it goes back to that point that we made at the start about trying to work out a time to get started, delaying when getting started. It tends to be that people will delay from getting started in the stock market until they hear about this stock that's performing really well, whether it be from one of the other points as well about it coming from a mate, or they see it in the news. All of the points that we've already covered in this video all coming together in one to prompt somebody to get started in investing in the stock market. One, going after one particular stock and putting all their money in one place, leaving them highly exposed to risk. But 2, jumping in on that stock when it's likely already had its growth spurt and any future growth is already built into its price. If you're hearing about it in the news, or you're hearing about it from a friend, or you're hearing about it in the business meetings, all the other things we discussed, the likelihood is that that stock's already grown. That's why you're hearing about it, because it's already earned the people that are talking about it the money because they were invested in it before it grew. If you now jump in at this point, all you're likely to be doing is maybe siphoning off some of the top level of growth, or you're going to be in for the ride on the downside of that growth spurt that the stock has been through, and then you'll find that you're just losing money and it will damage your confidence further when it comes to investing. And if there were just constant winners in the market, that's what everybody would invest in, and there would almost be no risk involved with investing because everyone would just go after the stocks that, oh, this stock is just always going to grow, it's just going to continue to keep growing, so let's just put all my money here. If that were the case, everyone would do that. Obviously, that isn't the case. And stocks and shares, their prices ebb and flow. Funds, whatever you're invested in, their funds, the number and the amount that they're worth ebbs and flows over time. So definitely something to think about. To mitigate this point, we're going to focus on investing for the long term, investing with a consistent strategy. It doesn't matter whether you want to pick a basket of stocks and shares that you personally choose yourself and you want to invest in, or you decide to go down a more passive route through investing in funds and things like that and having your money even managed for you potentially. It doesn't matter which direction you want to do as long as you take the consistent approach. Consistently add money into your account, consistently keep reviewing your investments, and consistently keep mapping out how much money you're going to need for, if it's retirement you're investing for, or whatever your financial goal is. If you stay on top of those things, you'll have a consistent strategy that will allow your money to compound and grow over time. Instead of chasing those individual stocks that you think are going to be the next wonder stock, that consistent approach gives you a much more solid foundation to build your investment portfolio up. This next one on the don't list is one that I'm personally a big advocate of, and that's not fixating on the detail. It's really easy to get caught in the trap of, if I'm going to put my money into this fund or this stock or this share, I have to know every single individual thing about it. And whilst that might be more true if you're looking to invest in a small amount of individual stocks, if you're looking at going down a fund investment route, you look at investing in ETFs, global funds that track the market, dividend paying stocks as well probably falls into this category. You want to build a dividend portfolio. If you spend too much time fixating on the detail, going back to a point I made earlier, you're really just going to end up finding reasons to convince yourself to not start investing. And I found that initially when I started out on my journey. I was keen to look at putting a portfolio together that I knew was going to give me guaranteed returns in the future. But that doesn't exist. There isn't a portfolio out there that is going to give you guarantee 100% is going to return you this amount of money. All of it is effectively forecasting and predicting based on past results, and that's really what all of investing is. And it's important to harvest some of that information and make sure you understand what it is that you're investing in and what the likely growth of that is in the future, what that might look like. But spending too much time fixating on the detail, getting into the nitty gritty, especially with individual companies, you'll always find that one thing that will stop you from investing, and at which point you spend a lot of time looking into investing but not a lot of time actually getting your portfolio moving. If you want a portfolio that's going to grow for the future and one that's particularly going to make sure you've got enough money to be able to retire on, delaying at the start can really cost you quite a lot of money in the future, because you're giving the compound interest the less opportunity to have an impact on your money over time. So instead of fixating on that detail, take a more holistic view, take a step back and think about, what's your long-term goal? Where do you want to be? How much money do you need to be able to hit that goal? And what does your journey look like in between? What route do you want to take? And then, just as I've mentioned before, just consistently follow that path rather than fixating on the individual detail, and you'll at least put yourself in the right ballpark for achieving that goal at the end. You might need to make some changes along the way, but you're setting out a clear path of how you're going to get from point A to point B with your investments. The last point, and this is a little bit more of a don't forget rather than don't do this, is always make sure you're checking the fees on the platform that you're using for your investment, your pension, however you're putting your money into the stock market or whatever it is that you're investing in. Just check the fees associated with that account. Fees can really rack up, particularly in the later years of your investment journey, your portfolio, and you're looking to come to retire perhaps, and you've built a few £100,000 up maybe in a portfolio. The fees at that point can really make a difference. They might not make a massive difference at the start when you've maybe only got a few £100 or low £1,000 to invest, but if you're unable to make sure you've got an account that has fees that are suitable for you, you could find quite a lot of your money getting eaten into later down the line. So just make sure you're checking the fees, make sure you check all the platforms. I've mentioned it earlier, and I'll make sure I do it in the description. I'll link down a few, particularly stocks and shares ISA accounts, down in the description below that you can have a look at. You can compare all their fees. I personally, for transparency, I use Trading 212 stocks and shares ISA. The fees are incredibly low on that account, so definitely go and have a look and check that one out. But also there are others out there, and they're all very, very comparable to each other. There are some that are no fees at all as well. So yeah, definitely go and have a look at those, or no fees up to a point, I should say. So definitely go and check those out. Work out which one's best for you, and then just make sure you're staying on top of it. Any account changes and things like that, because you don't want those fees eating into all of your hard-earned money that you've built up on this journey. Hopefully you found this video useful. That's just some of the things that I suggest you watch out for or don't do when you're starting out your investment journey, or you're continuing on your investment journey to build up your investment portfolio. By watching out for some of those things and making sure you don't fall into some of those traps, you'll be able to keep your money safer and give it the best chance of growing long term for the future to hit those financial goals that you have. I'm going to be doing lots more content like this about investing, building emergency funds, side hustles, just lots of financial, educational related topics. So if you've got anything in particular that you really want me to cover in the videos, please do drop it down in the comments below. I'll always take on board any suggestions and look at other content that I can film. Hopefully you enjoyed this video. If you did, give it a like, and if you want to see more of that content I've got coming up, then make sure you subscribe to the channel as well. It really helps the channel and helps me kind of motivate me to help create content as well. So yeah, thank you very much for watching this one, and I look forward to seeing you in the next one.